When you think about it, what are you really investing for? And then how are you making those decisions? Today, we're going to talk through our 3-step process and how we make investment decisions. Stick around.
So when you're starting with anything you want to accomplish, you first got to start with developing a plan, right, Mike?
That's right. I'm with that comment, I'm reminded by a Benjamin Franklin quote, if you fail to plan, you are planning to fail.
Absolutely. So how do we set up our 3-step process? If we're starting and talking through developing that investment plan, what are some steps that we consider in that first step?
The first step is really developing that plan. Is what's the money for and when are you going to need it? Is it retirement? Is college for the kids? A legacy for your family? Is when you need the money, and that money needed in the short term should be in safe, high quality investments, and longer term money should be invested in global stocks for long-term growth. And so that is something we call risk capacity as our first step of our process, is to determine how much risk you can take depending on when you need that money.
Yeah, I like the idea that we talked through the short-term pessimists and long-term optimists that we got from Morgan Housel there, and considering stocks, bonds, and cash in those decisions. And then if you move into that second step, after you consider how much you need to withdraw from your portfolio, you're starting to dig into the actual investments that you're using, and that's implementing the plan. So that's step 2.
Yeah, this is where we start to get into the details. This is you're starting to pick the individual mutual funds, ETFs, or stocks you're going to pick, or bonds. It's determining, what the mix is going to be, how much you're going to own of what. From our process, really the first part is picking those. We primarily use funds from Dimensional Fund Advisors, or DFA. So these are high quality, low cost, tax efficient mutual funds and ETFs. The next part is we typically tilt the portfolio towards areas of the market with higher expected returns. The example I like to use is an ice cube tray. Your typical index fund is just going to have an equal amount of water in each area of the tray, where we're going to put more water in areas of the market with higher expected returns. How we do that? A couple of ways. One is first based on the price you pay, and that's something called valuations. For example, today we tend to tilt more towards international stocks versus U.S. stocks. There's also something called factors obviously with DFA mutual funds. They do a very good job of that, and that's tilting towards small, profitable, and value companies. So that's really kind of how we differ from your traditional approach.
Yeah, the takeaway there is you need to have some rules in place around the investments you're using, because as we talked about in our podcast, so many people could get caught up in the stock picking of the Teslas, the Amazons, the Apples, this year the GameStops, cryptocurrencies, right? And those are what gets talked about. But having a process where you can implement the investments and then stay invested is key. And then if you talk about how you stay invested, that's our third step, moving into monitoring the investment plan. Let's talk about how we do that.
Yeah, and this is the area I think a lot of people fall short on. It's a lot easier to kind of pick your investments, get started, but then actually following through on it is more of the chore, the more challenging part. And that's through a few different aspects. One is, I like to call opportunistic rebalancing. We saw this last March 2020 when the stock market dropped by 35%. What did you do? We were active buyers of global stocks during that time, which has worked out well for our clients. The second thing is tax efficiency. A lot of folks focus on, the cheapest mutual fund or ETF or investment, but, I think, trying to save on taxes through, where you put certain investments based on either, a brokerage account or a 401k or an IRA. And then also, we've done on previous podcasts is tax loss harvesting, where you take advantage when the market is down to move to different investments and to realize the loss, to lower your tax bill each year. So that's, another part of the process. And then the final thing is we don't believe in a set it and forget it approach. Your investment process should be ongoing. And that means there's times where we need to make changes to your investment approach, your plan. And that means, you need the money sooner, you're going to retire sooner, or, there's events in the market that justify either taking on more risk or less risk. So monitoring is probably one of those things that's the least exciting, but as important as the first 2 steps, which is developing and implementing the plan.
Yeah, there's some core components of that step, I think, that you got to remember, and it's having accountability to be able to know how you're doing against what goal that you set. right? And then the transparency around, if you're working with an advisor, you want to know, is this an effective strategy, right? Is this rules-based process, is there a way to verify that things are getting done in the way that they should be getting done? And to do that, you want to have someone that communicates with you effectively. So we do that. We have details on this process. We showed a few slides here, and we have more on our website. We'll have a link in the show notes below that you can check out on the Symmetry investment solution, we like to call it around here. Mike, thanks for joining us today. And if you want to check out many other episodes we have here or 130 episodes of our podcast, you can do that. If you don't want to miss our next video, you can subscribe over here. And we look forward to joining you again in 2 weeks.